Hey, this is Mike Seagraves with No Ceiling Real Estate, bringing to you a class that is very important in what we do in real estate, and it's the 11 steps for business planning in real estate. At the outset, you have very little chance of success if you don't have some goals in mind. The 11 steps is what we're going to refer to as the entrepreneur's mantra or entrepreneur's path. Entrepreneur's mantra is another class that we go through. Entrepreneur's path. At the beginning, you must understand. The first one is you must understand your why. Why are you getting into real estate? Why are you getting into sales? Why? What do you look to achieve? Are you looking to pay off the house? Are you looking for a second home? Are you looking to purchase another vehicle? What is that? So you need to define what is your why. What's driving your passion? If you can't give me or your manager a reason for why you're doing this, then it will be lukewarm and will probably fail. So number two is budgeting. So we break budgeting into two pieces. One is the personal budget, and the second one is the professional budget. So let's talk about the personal. The personal, first and foremost, is you want to take 3 to 5 months worth of personal expenses and come up with a monthly estimate. I realize that most people don't do a great job of balancing their monthly personal budget. I am not the greatest at it myself. So take 3 to 5 months, average those, come up with an annualized number. That is what it costs to fund your personal budget. The second one would be your professional budget. So you want to be able to get a business checking account. If you have no history in real estate, then obviously this is going to kind of be fly by the seat of your pants. You're going to need to probably reach out to a manager or a sponsoring broker and have them help you create that budget. If you're an existing real estate agent or you're already in sales, then you already have a concept of what it's going to cost for you monthly and annually. So at the end of that, you're creating a personal and a professional budget to fund your lifestyle. Um, so the last two pieces I would say about this is when it comes to the professional, you are the CEO of your company, and for every dollar you spend, you should have a return on investment or ROI. If you're going to send $1,000 out in advertising, you better get more than $1,000 in return. And what I find a lot of people don't do is they don't track the return. If you're not going to track the return, don't spend the money. You're probably just throwing it away. Sometimes you're lucky to spend money and you don't track it, but I will tell you more times than not, I would tell you if you're not going to track it, don't spend it. The other one is don't finance your ego. So what do I mean by that? A lot of times you have some success in real estate and all of a sudden you realize I need that luxury car. I'm going to go lease this car. I'm going to go leverage in a loan with this car, and you probably get above your means very quickly. Just because you are selling real estate, just because you're successful at real estate, doesn't mean that you need to be driving around in a $125,000 vehicle. If it works for you and your budget, then that is by all means acceptable. But at this point, we've created a personal and a professional budget. So then we move to step number 4, which is your financing goals. Financing goals is taking the personal and the professional budget and adding them. So that gives you a net income. You then need to account for the fact that you're going to be paying the IRS. And so I'm going to tell you to multiply that net income by 1.12, or if you are a producing realtor, 1.22. That will gross that number up to something that will account for taxes, personal budget, professional budget. So here's an exercise that I want to kind of walk you through. So taking the annual financing goal, which was, let's just say your goal in the last step was to get to 100 grand. So personal budget, professional budget, grossed up to 1.22 or let's just say 1.12% would take you to 100 grand. Let's just say you needed 100 grand. Let's also make an assumption that your average commission per deal is $4,000. So you would take the $100,000 divided by the $4,000, and that would dictate that you need 25 deals to make that money this year. We also need to make another assumption, and that is that 50% of your deals will be buyer and 50% of your deals will be listing. Now, if you're a brand new agent, I would tell you that statistic is probably more in the 75% buyer and 25% listing world, but it kind of depends on you and your database. So, offline, I can explain to you the statistics on this, but statistically, math would indicate that if we're trying to close 25 deals at a 50-50 split, that you need 17 listing seller appointments and you need 17 buyer appointments to close 13 each. Let's face it, you're not going to meet with 13 people and close 13 people. So you're going to need to meet with, we estimate, 17 people to get to 13 people. And so what you're doing is adding the 17s together, and the number of clients you need for this next year would be 34. So 34 will boil down to 26 deals. 26 deals times 4,000 in commissions will be $104,000 in gross commissions, which again pays for your taxes, your personal budget, and your professional budget. So the next step we would get into is contacts. So how are you getting these contacts? You need 34 clients. Now how do we get those people that turn into clients? And so now we're going to turn our attention on contacts or customers. A client is somebody we're working with. A customer is someone we casually know. So what is a contact? By definition, we would say it's face-to-face contact. We would say it's a phone call, a text, written message, or an email. So those mode of communications would work as contacts. Statistically, we feel that you need to interact with 35 prospective customers to come up with one client. Let me say that again because that's a big number. We feel you need to communicate with 35 prospecting customers to find one client. So if you go to the local restaurant today and you strike up a conversation with someone there and you give them your business card, that would be one customer. You need 35 of those to equal one client. So let's do the math. 34 clients is what you needed in our prior example, times 35 prospects would equal 1,190 contacts that you need this year, or if you're working 5 days a week, 5 a day is what that is. So you need to reach out to 5 people a day over the course of 1 year to get to that number. Now that sounds like a big number. Let me kind of use reverse logic and me kind of explain it a different way. So what is a daily contact worth? So again, you wanted to make 100 grand. You divide that by the 1,190 contacts, and that's $84. That is the value of each client or each customer. So let me say that a different way. We talked about the reverse psychology. So in another way to say this is for every customer you are earning, for every customer that is telling you no, I'm not interested, or it falls on deaf ears, that person is worth $84. So I guess my question to you is, if I told you your job today was to go out and preach a message about you being in real estate, and for every time you got told no thank you, you got $84, how many times would you do it? And that's usually where the light bulb clicks on and everybody says, well, I could do that. And keep in mind, you're not getting the $84, but when you eventually get the client who's paying you $4,000, we're dividing it to come up to a value of $84. I think that should make sense. So the next step is marketing. To kind of know where you want to go, you have to know where you've been. If you're already in the business, then you need to dissect where you got your business from. Listings versus buyers. Traditional versus commercial. Was it land? Did you get them via expired listings, for sale by owners, whatever? So you need to target markets, and in my brokerage we use some training called momentum training. In that training we break it out into disciplines. And so we talk about how we really don't want you to take and try and learn more than 2 or 3 disciplines at a time, because we realize that you can't be everything to everyone in every discipline. So you kind of got to figure out what works best, which kind of leads me into the next step, which is training. Training for us is very, very important. And every real estate brokerage says it has training. But the key to success with training is a 3-step process. First and foremost, you must sit down with your manager or your sponsoring broker, and you must talk about your strengths and your weaknesses. And you need to do what we call consulting. You need to talk about what it is I'm good at, what is it I'm weak at, and then I need to go train in the areas that I'm weak at. Why would you go and spend your time on the things that you're good at when you could spend that time on the things that you're weak at? So you need somebody around you who can help you with that. The third piece of training that we feel is the most important is the accountability phase. At the end of the day, you're going to take a class and you're going to take the materials and you're probably going to go home and you're going to put it on your office desk and you're going to get to it next weekend. Next weekend turns into next month turns into the next class. And so you're going to be repeating this class. The accountability phase is the backbone behind our success. You have to have somebody around you who's going to mentor you, who's going to walk you through what implementing these classes looks like, and break them into small pieces and make them part of your real estate DNA. So much so that the next step, we continue it into accountability. You need to make your goals known. People need to know what your goals are. What are you looking to achieve? You're most apt to follow through if people around you know what your goals are. Because if you keep them to yourself, nobody knows about them. And it's human nature to change what our goal is throughout the year so that it makes us feel better. And so you need to have somebody around you as a mentor who can help you stay on track. The last step is goals. So you need to have goals. They need to be written out. They need to be they may be a weekly goal, a monthly goal, a quarterly goal, an annual goal. I've even got goals that I've pushed out 10 years. Don't have more than 2 to 3 goals that you're working on specifically at a time. Sometimes the goals that you have for this quarter are stair-stepping their way into something you're trying to be successful at the end of the year. That gets a little more involved, but no more than 2 to 3 goals. They must be specific and measurable. They must have a time frame associated with them. You can't have too many goals because they're diluted and lose focus. And in the end, surround yourself with people who can help you. There are a lot of people that cheer you on and celebrate your success. Find those people, make them part of your board of directors, and follow through with your goals so that you can succeed. Hopefully this has been help. This is the 11 steps of business planning as you prepare for real estate. This is Mike Seagraves with No Ceiling Real Estate. Take care, be safe.